Bitcoin has climbed from the mid-$60,000 range to around $80,000 in only a few days. So what changed? There was no single announcement that suddenly made Bitcoin more valuable. Several forces arrived together, and each one strengthened the others. To understand the rally, start with the simplest market rule. A price rises when buyers become more aggressive than sellers. That sounds obvious, but the important question is who is buying and why they are buying now. Bitcoin has a maximum supply of 21 million coins. However, the daily price does not depend on all 21 million. It depends on the smaller amount that owners are willing to trade today. Many coins sit in long-term wallets, corporate treasuries, or investment funds. When available supply is thin, a new wave of demand can move the price quickly. The first force behind this rally is the broader money environment. Investors constantly compare cash, bonds, stocks, gold, and Bitcoin. When interest rates and the dollar look attractive, risky assets must compete harder for money. When investors expect easier financial conditions, they become more willing to own assets with higher risk and higher potential returns. This is often called improving liquidity. Liquidity does not mean that the Federal Reserve directly buys Bitcoin. It means that money becomes easier to move through markets and investors feel less pressure to stay in cash. Recent dollar weakness and expectations of easier financial conditions helped create that background. Bitcoin also began to trade more like gold in the so-called debasement trade. Some investors worry that currencies will lose purchasing power over time. They therefore look for assets whose supply cannot be expanded easily. That story alone does not explain a 20% move, but it can change where large investors place their money. The second force is much easier to measure: spot Bitcoin exchange-traded funds. An ETF lets an investor gain Bitcoin exposure through a normal brokerage account. The investor does not need to manage a private key or transfer coins through a crypto exchange. That creates a familiar entrance for pension advisors, wealth managers, companies, and ordinary investors. During the 3 trading days from August 19th through August 21st, United States spot Bitcoin ETFs recorded strong net inflows. The daily totals were roughly 517 million, 606 million, and $308 million. Those flows do not guarantee that the price will keep rising, but they show that the rally included real demand through institutional channels. Now imagine a shop with a limited number of products on the shelf. If many new customers arrive while existing owners refuse to sell, the price must rise until someone changes their mind. Bitcoin's market works in a more complex way, but the pressure is similar. The third force turned a normal rise into a much faster one. It was a short squeeze. A short seller borrows or uses a contract to benefit if the price falls. If the price rises instead, that position starts losing money. The trader may choose to close the position, or the exchange may close it automatically when the loss becomes too large. Closing a Bitcoin short usually requires buying Bitcoin or an equivalent contract. That means a person who expected a fall becomes a forced buyer during the rise. The first wave of buying pushes the price higher. That higher price hurts another group of short sellers. Their forced purchases then push the market higher again. This chain reaction is why a crowded market can suddenly jump even without a new headline. ETF demand may have added fuel, while short liquidations made the fire spread faster. Momentum traders added a fourth force. These traders buy because the price has broken above a range or an important level. They are not necessarily making a 10-year judgment about Bitcoin's value. They are reacting to the strength of the current move. As financial news and social media notice the rally, more people become afraid of missing out. That feeling is known as FOMO, and it can bring late buyers into the market. At this point, it is useful to separate a trigger from an amplifier. Better liquidity expectations and ETF inflows helped create new demand. Thin tradable supply, short liquidations, momentum, and FOMO amplified the price response. This distinction also explains why Bitcoin can fall just as quickly. If ETF flows reverse, the dollar strengthens, or early buyers take profits, the same market can lose support. Leveraged traders who bought during the rise can then become forced sellers. So does this rally prove that a new bull market has begun? Not yet. One powerful week shows that institutional demand can return quickly, but it does not prove that demand will remain. 3 signals are worth watching. First, do ETF inflows continue after the excitement cools? Second, do the dollar and financial conditions remain supportive? Third, does Bitcoin hold its gains after the short squeeze is finished? If the answer to all 3 is yes, the rally has a stronger foundation. If not, this may be a sharp relief rally rather than the start of a lasting trend. The beginner's lesson is simple. Bitcoin is rising because real demand returned at a moment when tradable supply was limited. Macro expectations and ETFs helped start the move. Short covering, momentum, and FOMO made it much larger. That's all for today's episode. A fast rising price tells us that buyers are winning today, not that risk has disappeared tomorrow. Thanks for listening, and we'll see you next time.